Personal finance practice problem using OneNote. Annuity due or annuity where the payments happen at the beginning as opposed to the end of the period. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 1217 Annuity Due or Annuity Beginning Period tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculation on down below. We're looking at the comparison between a normal annuity, future value in this case, versus an annuity due or an annuity where the payments happen at the beginning of the period, or in other words, normally when we think about an annuity, we're looking at a series of payments. The payments have to be evenly intervaled in order for us to do one nice even calculation for them. And usually the assumption will be that the payment is at the end of the time period. That's the normal assumption when we do our annuity calculation. But you could say, well, what if I put it at the beginning of the period? As long as I have a nice even interval of the payments, could we do that? We could. It wouldn't be the normal default setting, but possible. So to think about that, let's first think about the normal annuity and then the adjustment for it. We'll kind of think about it first with the calculation of the Excel function to create these annuities. So we got the payment of $1,000. We got the rate of the 5%. The years are going to be 6. So if we did a future value of annuity at the period end, meaning payments happen at the end of the period, at the end of each of the 6 years in this case, then that would be a normal type of annuity in the Excel function would look something like this, equals negative future value of the rate. The rate would be the 5%. Comma, the number of periods. The number of periods would be 6, comma, and then we will be using the payment function because this is going to be an annuity. The payment then would be that $1,000. Then we're going to say comma, and we've got the present value. Well, we're not saying comma here. Note, we stopped it there, and that's all you normally have to do for a normal annuity. You don't need to do these last two arguments for a normal annuity. But if you want to then make it an annuity that's going to be at the beginning of the period, or you want to define more thoroughly that it is an annuity that's at the end of the period, a normal annuity, then you'd want to go over to this type field on the end in order to define that. So you could say comma again to skip the present value thing, which would be 2 commas, and then get to the type. The type is where you can then say, do we want this to be a normal annuity, or do we want the annuity to have the payments at the beginning of the period? Again, if you ignore the type and just do not put the type in there, default will be that it's a normal annuity. That's why we haven't really worked with the type at all, because we're typically working with normal annuities. So the normal annuity would be this 6,802. And now let's think about what would happen if we had an annuity at the beginning of the period. So we would then have the same information. This is going to be the future value of an annuity where the payments happen at the beginning of the period as opposed to the end of the period. And so that's going to be equals negative future value, same starting point. The rate is going to be the 5%. Number of periods is going to be 6 number of periods, comma. The payment is going to be 1,000. And then we have a comma. We don't have any present value, because the present value is typically what's going to be used when it's not an annuity, and a future value of 1. So therefore, we're going to put 2 commas there in order to get to the type field. Now, when you plug this into Excel, there's actually once you get to the type field, it'll have a little bit of a description that'll say, if you put a 0 there, then it assumes the payments happen at the end of the period. And if you put a 1 there, it assumes that the payments happen at the beginning of the period. So you could go all the way out here and put a 0, and you would end up with the same calculation you had up top for the normal annuity, which is why you don't typically do that. Typically, if you're going to go out here, you're then going to be trying to do something different, which is to have the annuity at the beginning of the period, which would be indicated by the 1. And of course, you'll get a different result because there's going to be different earnings on it. So if we had the payments happening at the beginning of the period, we'd have a little bit more money in there. And so you would expect then the future value to be a little bit higher. as it is here. So we'll see a running balance of this now. Let's kind of do our standard running balance first. So this is the running balance of a normal type of annuity. Notice it starts on period 1. This is just a normal annuity. And this is often a point where people have confusions about an annuity, whether it starts on period 0 or 1 and so on. That starting point is of confusion oftentimes, especially when you're thinking about an investment situation that you're thinking, I'm going to put money in today and then a year from today and so on and so forth, right? So there's two ways you kind of deal with that. One is you might say, well, I'll put money in today and that'll be my starting point along with any base money that you have, and then start the annuity calculation, assuming period end, normal kind of annuity calculation. That's one way to do it. Or you might say, I'm going to start an annuity kind of at the beginning of the period and instead, and it would look something like this. So those two ways you can kind of think about that situation. So normally we got the payment. Notice the payment is happening in period 1. That's going to be the $1,000. But there's no interest being earned in period 1 because we're assuming in year 1, in this case, the payment happened at the end of the year, and therefore the investment is the same. And then we're going to say that there's an increase in year 2, and that's when we start to calculate our interest. So then we got the 1,000 times the 0.05. That's going to give us our $50 of interest, plus we're putting in another $1,000. That means we got the original $1,000 plus the $50 plus the $1,000. We're now at the $2,050. Then we can take that and we can multiply it times 0.05, and everything else is fairly straightforward. We're going to say that's the 103 about. There is rounding involved. We'll put in another 1,000 at the end of year 3. And so now we've got the 2,050 at the end of year 2 plus the 103 about plus the 1,000 is going to give us an ending period at year 3, the 3,153. Multiplying that times 0.05, we get about 158. We put another 1,000 in at the end of year 4. Notice we're not calculating any interest on this 1,000 because we did it at the end of year 4. We'll calculate interest on it when we go to year 5, right? And so we're going to say this is going to be then the prior amount, 3,153 plus the 158 plus the 1,000 is going to give us our 4,310. Then we can multiply that times the 0.05. We're going to get the 215, 216 plus another 1,000. Brings us to 4,310 plus 216 plus 1,000 is going to get us to the 5,526. Let's do that one more time. Hold on a second. 4,310 plus 216 plus the 1,000. 5,526 times the 0.05 again. Finally gets us to 276, plus we have another 1,000 that we put in at the end of that period. That's going to give us the 5,526 plus the 276 plus the 1,000, or the 6,802. So then we can think about this. Let's think about it as if the payments happen at the beginning of the period. And this time, this first one, I'll add a period 0. Now, this is kind of me trying to make a table that is the exact same kind of formatting as the table above, but it's not a perfect type of scenario. And then we'll see it in another table where we adjust the headings. But this one, you got a similar kind of setup, so hopefully it'll look familiar. And so I'm going to start with like a 0 up top, and then we're going to go down to period 6. The first payment we're going to say is going to be that 1,000. Notice I'm having it in period 0. And this is where like the twist is. It's really not happening in period 0. We're kind of imagining it happens on January 1st of period 1, the beginning of period 1. But in order to have the same kind of table, we'll have it at the end of, you could think about it as in essence the same day, right? The end of last year is the first day of the current year. So we'll put it basically at the end of period 0, even though we're kind of assuming it doesn't happen until January 1st of period 1. And if you make that assumption and just keep that straight in your mind, you could set up the same kind of running balance tables, because then we can calculate, okay, the 1,000 times the 0.05 means we got the $50 that was earned in period 1 in this case, as opposed to the $50 earned in period 2 up top, because up top we assumed the 1,000 didn't go in until the end of year 1. This time it's at the beginning of year 1, which we're actually posting at the very end of the prior period, so that we can have the same table. So there's the $50, and then we got the $1,000 payment. Now, this $1,000 payment is a little tricky because remember, we're really kind of assuming that happened on January 1st of year 2, and we're instead putting it on, like we're assuming, December 31st of year 1 here, which is kind of like the same day, but the investment amount over here is a little bit deceiving because, again, it's showing including this 1,000, which we basically would say it happened at the end of the year or at the beginning of the prior year. So that's where it gets a little confusing. Our next table will kind of address that, addressing it by having a beginning and ending period date. So really what would happen is we'd go, okay, we got 1,000 plus, that's 10,000. That's 10,000. That's a totally different number. 1,000 plus 50, that's how much we would have at the end of year 1. And then we're assuming this goes in on January 1st of year 2, or you could think of it as like December 31st of year 1, which is kind of like the same date. And so if I added the 1,000 to it, that would get us to that 2,050. And that allows us to calculate then on this 2,050, which includes this $1,000, the 5%, 0.05, which would then be the increase for year 2. And then the next 1,000 is we're assuming again would be input at the end or at the beginning of year 3, which is kind of like the same as December 31st of year 2. And so then we could say, all right, we got our 2,050 plus the 103 plus the 1,000 is going to give us our 3,153, and then we can multiply that times 0.05. That would give us then the 156. We put in another 1,000, and once again, note when I add this together, I'd really have the 3,153 plus the 158 about gives us about 3,311, and that would be the balance for the end of year 3. And then this 1,000 is really going in there like at January 1st of year 4. This is kind of similar to December of year 3. So we'll add that, the 1,000, and that would give us our 4,310, multiplying that times 0.05. That's going to then give us our 216, and then we're going to add another 1,000. So once again, we have the 4,310 plus the 216, which is really what we have at the end of year 4. The 1,000 we assume is going at January 1st of year 5, which is similar to like December of year 4, plus 1,000 would be another 5,526. Multiplying that times 0.05 gives us then the 276 plus another 1,000. So we'd have the 5,526 plus 276. That would what we would have at the end of year 5. The 1,000 kind of going in at the beginning of year 6, or you could assume at the end of year 5, and then we add that plus the 1,000. That's going to give us our 6,802, and then finally we take that times 5%. We get the 340 plus another 1,000. I'm sorry, we don't have another 1,000 here because once again, this 1,000 we're saying was at the beginning, really the beginning of year 6, which you can also think of as kind of like December 31st of year 5. So we just have the 340, and adding that to the 6,802 gives us the 7,142. So you can see a nice parallel between these tables and kind of the offset that's happening due to the different dates that we have. And both tables have the 1, 2, 3, 4, 5, 6 payments of the 1,000. 1, 2, 3, 4, 5, 6 payments of the 1,000. If you end up with like 7 payments of the 1,000, or over the number of payments, then you probably have something off on your table, the way it's lined up. We can also set up the table this way, a little bit more complex looking, but it may be easier to actually see what's going on. We've got our years from 1 to 6 again, but this time I'm going to have the start of the year versus the end of the year. So in that case, we could say, all right, the payment's going to go in at the beginning of year 1, and then we're going to say that our investment at the beginning of the year 1 is 1,000. We can then calculate our increase, which is 5% of that 1,000, and in this case, the year end, and then the year end investment total amount would be the 1,000 plus the 50 that was earned during the year, because we put that 1,000 at the beginning of the year and it earned money throughout the year to get to our end balance. Then we put in another payment in at the beginning of the year of year 2. So now we have this one at the beginning of the year instead of this funny thing that happened over here where we're kind of assuming it's at the same date, end in the beginning. And then with that 1,000 plus the 1,050 gives us, this is where we are at as basically January, the beginning of the period. Then we can calculate our interest on that 2,050 times the 5% gives us about 103. And now I can add these two together to give us the about for year 2 at the end of the period. So now then we could say, okay, then in January 1st of year 3, we put another 1,000 in it. That 1,000 plus the year 2 ending balance would give us to the 3,153. Then we can calculate the increase, the interest, depending on the type of investment of the 5% increase. 3,153 times 5% is about 158. Adding the 3,153 and the 158 would give us the 3,310. We add another 1,000 at January of year 4, January 1st, year 4. That means we got the 3,310 plus the 1,000 or the 4,310. That we multiply that times 0.05 or 5% to give us the 216. And then we can add the 4,310 beginning balance plus the 216 to get to the ending balance of the 4,526. Then we add another 1,000 at the beginning of year 5. We then say that that's going to be added to the 4,526. That gives us our beginning balance here of the 5,526. Multiplying that times 5% gives us the 276. And then we can take the 276 plus the 5,526 to get us to the 5,802. Then finally, another 1,000 added at year 6, beginning January. That plus the 5,802 gets us to the beginning balance of the 6,802. And then we have the increase, 6,802 times 5% gives us the 340. We can add then the 6,802 plus the 340 to get to the ending balance of the 7,142.